Welcome to The Pulse. I'm Jennifer Ray, your host, and today's subject is taxes. And I am honored to have with me a most fabulous CPA, Mr. Jeff Polinchock. And I've known Jeff for 20 years, and when we were going to do the topic of taxes, I couldn't think of anyone I wanted to have on as a guest any more than Jeff. So Jeff, thank you so much for coming out to Spring Park, and welcome to the program.
Oh, thank you, Jennifer Ray. There's nobody else I'd rather be talking to about taxes than with you here on The Pulse today.
Well, thank you. So we're going to cover the top 10 things that people might be interested in for 2015 tax season and going into 2016. And the first is the tax day that you actually have to file your taxes for this year. Jeff, what would you like to say about that?
Well, it's Emancipation Day in the District of Columbia. It falls on a Friday this year, Friday the 15th. And because it's a holiday in the District of Columbia, the IRS is closed, and we have now this year until April 18th. So get an extra weekend to lose and to do extra tax work that would otherwise be done on Friday. So
that's true. And we both do taxes, only Jeff does it on a much higher level. I do it for, you do business taxes, and I do it at a much smaller level. So it's fun to have you here today. And it's fun that I've only been doing this for a couple of years, and it's just very interesting. And so I want to share a story about the tax penalties that are related to Obamacare, and they're going up again. There's a lot of people, I'm surprised how many people don't have health insurance when this became enacted. And last year was the first year that you actually have to reconcile if you use the MNsure website and you received subsidies from the government to help pay for your health premiums. It's called a 1095A is what they get. And there's a column that shows what the actual premium is, and then there's a column that shows what they received in actual subsidies. And there was a couple at the tax desk as we're going over that when he went on, he had no idea, obviously, that this was reconciled with the taxes, and they owed like $3,500 because he went on there and said they made, like $10,000. I don't know what he put on there, but of course they owed all this money back that they were getting in premium, and so there's something wrong. He's yelling. The wife is, I told you so, I told you so. She understood exactly why they were, having to pay this money back. And so if you know of somebody who's lost their health insurance, just want to go over a couple of things. In 2014, the penalty wasn't too bad. It was 1% of income. And in 2016, or for tax season 2015, which we're in right now, it's 2% of income, goes up to 2.5% of income. So it can actually be quite substantial. And I've only had 2 people so far this year that had no health insurance and had to actually pay the penalty. And it's a surprise, and it's not a pleasant one. So if you don't have health insurance, it is important to do that. The third item is the tax brackets are rising slightly. And just to go over some of the tax brackets that there actually are, we've got, and I'm going to use married filing jointly just because that's probably a more common, but we've got, if you're 18 to 74,000, you're in the 15% bracket, just under 75,000 to 151,000, 25% bracket, 151,000 to 230,000, you're in the 28% bracket, and 230,000 to 411, you're in the 33% tax bracket. 411,000 to 464,000, you're in the 35% tax bracket, and if you make over $464,000, you're in the 39.6 tax bracket. Plus, you're in the almost 10% for Minnesota. So that's where we get up to that 50% in the top tax bracket. Now, one of the things that I wanted to talk about with you, Jeff, is AMT. I don't really have to deal with that a whole lot. I think in the taxes that I do, I've only had to deal with it once. But most people don't know what it is or how it affects them. Can you share with people what is AMT, how is it affected, extra tax?
Sure. The alternative minimum tax, or AMT, is a parallel taxing system that computes a minimum tax that's due, eliminating certain deductions. And for most people, the deduction that's most common or relevant is the deduction for state income taxes that you would otherwise receive under the regular tax system. The biggest change that occurred with respect to AMT is that previously the exemption that was allowed for AMT wasn't being cost of living adjusted annually. So more and more people, originally the AMT was set up to make sure that wealthier individuals paid a minimum amount of tax. So there was a loss of preference items like state income taxes paid. And because that the exemption wasn't being cost of living adjusted, more and more people were getting trapped in it. And each year, Congress at the end of the year would come and do an AMT patch, and they would adjust the limit for inflation. Well, finally, that's been made permanent, so it's a lot easier to plan around. But basically, it's an alternative method of calculating your tax, eliminating preferences, and you're going to pay the greater of either the regular tax or the alternative minimum tax.
And how have you seen that work for clients on an actual basis? Is it?
Well, it's one of the things that you can somewhat plan around, because you can plan your, say, your state tax payment. Do I make it in 2015, or should I wait to make the payment, say, in 2016 to avoid AMT?
Sure, sure. Very beneficial. Also wanted to talk about standard deductions are going up for head of household filers. It helps, every little bit helps. Pennies all add up. It's $50 this year, so head of household is at $92.50 for 2016. It's going to be $9,300. And personal exemptions are rising again, another $50. This year it's $4,000. Then next year it will be $4,050 per exemption. Also wanted to talk about, I had just been talking about this in regards to divorces, because I work with planning taxes for divorces, because you have some of the lower income people greatly affected from joint, where they don't qualify for any of these credits, to all of a sudden you've got them separated, and some of them do. But it was posed to me, okay, so if a gentleman makes $300,000 and his wife makes, $30,000, is it even worth having the exemption? And quite frankly, at $258,000 if you're single, or $309,000 if you're married or remarried, I should say, then that exemption starts phasing out. So if you're, making $350,000, it's, becomes a moot point after that, and you might as well give all the tax breaks to the other person who would receive them in your tax planning. So there's a lot of tax planning going on. So I did want to make mention of that.
One thing that that wasn't adjusted for inflation this year is the Social Security wage base, which kind of goes up usually on an annual basis, but the 6.2% that's paid by both the employer and the employee stays at wages up to $118,500 for 2016, so there's no increase for that, which is a good thing.
Yeah, that's a very good thing. That's a very good thing. Thank you for bringing that up, because I didn't have it on our list today. And it is important, because after that, then, you make a lot more money. If your income is over that, you don't have to pay that Social Security tax. And then wanted to talk about contribution limits on health savings accounts, because those are going up just a tad bit also, but it all is wonderful. I don't have a health savings account, but I'm thinking of implementing one. Do you have a lot of people that have health savings accounts, or do you suggest that they have them?
Yes, I do. Those are offered in conjunction with a high deductible plan. And the advantage there is that the amounts accumulate tax deferred, but it's also something that is something that you can use. If you have those high deductible plans, you could be making contributions to your health savings account up to the filing deadline for your return, April 15th, and count those contributions towards as deductions for 2015 yet. So it is a way to impact your 2015 income tax if you are eligible to be making those health savings accounts contributions.
So you have to have the high deductible
Correct.
insurance plan.
Yes.
So that's part of it. Okay, so we've got that. Now the earned income credit, one quick story I will share on that. This is terrific for lower income people, and it is a credit that I will look at my cheat sheet here. It's a credit that this is for 2015 current tax season. If you have 3 or more children, it's actually a tax credit up to $6,242. And I had received, ironically, last week a call from somebody at our tax office, and the receptionist said, "Jen, can you please take this call? A gal's on the phone. She had her taxes done. She's received her refund, but she thinks it's done wrong, and she wants somebody to take a second look." So I got on the phone and I said, "Why do you think your taxes are wrong?" And it's because she was getting $6,100 from the federal government, and she was getting $2,100 from the state of Minnesota, and she made $29,000. So in probing with a few more questions, I asked her what her income was, which was $29,000. She'd just gotten divorced December 31st and had not lived with her ex-husband for over the 6 months. So she was going to pay off some bills, and she was all worried that there was some big error because, of course, with the combined income, they didn't get any of these credits. So, you know, she was pleasantly surprised that these were the credits that she was actually going to be receiving. And it can be quite substantial. So with that, I think we'll take just a little break, and we'll be back in 1 minute. Thanks for watching The Pulse.
Here's what's coming up on First Responder TV. I'll head to the South Lake Minnetonka Police Department to talk with the new police chief, Mike Meehan. A mother who lost her son to a drug overdose is using her foundation to help those affected by addiction. We'll give you an update on scams that have been targeting citizens in the Lake area. We'll talk with St. Bonifacius Fire Chief Shane Weber about how to ensure your home is safe on Safety Source.
First Responder TV airs daily on LMCC's Channel 12.
Welcome back to The Pulse and my special guest, Mr. Jeff Polinchock, CPA. And we are talking about some of the tax changes for 2015 and just notable tax items. So we've covered quite a few subjects, but I did want to touch base on the last two for our top 10, and that is the estate tax exemption is heading upwards. So for years and years and years, it was like at 1 million, and then when was that? 2008, 2009, it went up to like 3 million, and then it's slowly been rising, and we are increasing at 20,000 again for 2015 to 5.45 million per person, so that's worth noting. And there are other tax provisions that could change if they aren't renewed, and this happens all the time too. The government actually comes in about this time of the year, February, March, and they make some changes, so that can throw a wrench if you've already completed your taxes and you weren't a procrastinator, because they either make them and they rescind them, or else they add them to the tax code. So one of those notable here is teachers historically just got to deduct $250, but what I wanted to talk to Jeff about is the charitable distribution from IRAs, or charitable IRAs. So what can you tell us about those, Jeff?
Well, that was one of the provisions that was sunsetting in 2014, but it was extended and made permanent, which is really a good thing, because it's really hard to plan when items are scheduled for sunset and you get some form of gridlock, and then they're not actually extended until December, which was the case here. But thankfully, that provision was made extended and made permanent going forward. And what that allows is for individuals to make charitable contributions directly from their IRA to a qualified charity, and the amount is excluded from gross income as opposed to taken as a deduction as a Schedule A item. The difference there between the exclusion from income and a deduction is that other tax items, the amount of your Social Security that might be included in taxable income, or your medical expenses, are based on gross income. So by excluding that amount from gross income directly, it doesn't get put into those calculations, and it's a more favorable result for somebody who might otherwise be making charitable contributions with money that's already been taxed. So that's the benefit of that.
Oh, great point. You know, I hadn't even thought about that. Yes, because that definitely affects the other on the Sched A, the medical, which has to equate to, is it 10% now this
10%,
year?
yeah.
And the bottom section, which has to equate to over 2% with business expenses and tax prep fees. And I can't even think right now what else is in the bottom section there, but it greatly affects that. I didn't even realize what a difference that is until we had this conversation. And I do taxes.
Well, in the Social Security, taxability of Social Security can be dramatically different for somebody who's making those direct contributions as opposed to taking the deduction.
Yes, I get a call. I would say that it's almost every year for somebody that is having to take the mandatory distributions out of their IRAs, and then
Right.
now all of a sudden they're getting a tax bill of $7,000 that they didn't realize that they had to pay because prior to that they didn't have to pay on their Social Security, but it put them over that allowable amount for it not to be taxed. So that can be a big surprise. People don't realize, and that there again, the Roth IRA is fantastic for that too, if they can actually are able to do some planning with that.
If they've already done them.
Yes, exactly. So, and then I've got a last question for you, and that is, we hear on the political arena, and I have to laugh and giggle myself because I don't even know how it possibly would happen, but you hear people talk about how they're going to make taxes be on a little postcard and make them super duper simple. So what comments can you share with us about that thought process?
Well, I've been doing this for, well, over 25 years, probably closer to 30, and it seems that every time there's a effort to simplify, it creates complexity. And, one of the candidates specifically, Ted Cruz, says he would like to eliminate the IRS, which would be great conceptually, but some organization is going to have to administer the tax code, enforce collection. There's going to be some method of collecting taxes, whether it's a sales tax, a value-added tax, or some form of income tax. And not only that, you're going to have to define income. I mean, there's always, it seems simplistic to say, we'll put it on a postcard, but what is that postcard going to say, and where are we going to start when we, start to say, whatever, even a flat tax, what are we going to tax that on? How are we going to come up with the number that we start with? So I think it's misleading to consider that as really a viable option.
Well, I just don't know how that would ever even come to fruition. It's a nice idea, though, simplify things and make things easier, but I just can't see it.
And some of those concepts, too, get somewhat disruptive because when you start eliminating deductions, say, for example, the home mortgage interest deduction, people have made decisions and gotten to where they are right now based on a set of principles, our tax code, and they've taken out mortgages and things of that nature based on the current income tax code, and changing that can be extremely disruptive.
And so yes, so that they would. That's one thing I'm not sure, and I don't even know if you know. Are they talking about actually eliminating all of these deductions? I don't know. I haven't looked into it, but I'm like, I don't know how you would even figure out what would be or wouldn't be, and how you're bringing up the mortgage deduction. And
it depends on what the postcard says, I guess, because it really has been kind of obscure, not vague about what actually they're proposing, but it just it doesn't seem like it's really an honest possibility.
Sure. I don't know how they would possibly do that either. Well, Jeff, thanks for coming out to the polls and talking about taxes. And so I hope that you get your taxes done. Don't procrastinate too much longer. We do have a month and a half yet because we're actually filming this on March 1st. But be kind to your tax preparer. Get it to them in the next couple of weeks. With that, thank you so much for watching The Pulse. I'm Jennifer Ray. Until next time.